Seniors, don't miss this. Your benefits are jumping 25%. But there's a hidden catch. Something unusual is happening with senior benefits in Canada right now. And it's not what most Canadians think. Yes, there's talk of increases. Yes, there are promises of larger payments. But buried in the fine print hidden behind the headlines is a mechanism that could quietly reduce what many seniors actually receive. I'm Joseph, and I've spent years analyzing Canadian pension policy, retirement income systems, and how government changes affect real people. And what I'm seeing right now is a pattern that demands your attention. Because if you're 65 or older, planning to retire soon, or helping a parent navigate their benefits, what's unfolding could directly affect your financial security. This isn't about fear, it's about clarity. So let's walk through what's actually happening. Over the past 18 months, retirement policy in Canada has shifted in ways that haven't always made front-page news. There have been incremental changes to the Canada Pension Plan, adjustments to old age security thresholds, quiet recalibrations in how the guaranteed income supplement is calculated. And all of this is happening against a backdrop of inflation, rising government debt, and an aging population that's putting unprecedented pressure on public finances. Here's what most Canadians know. Benefits are indexed to inflation. When the cost of living rises, payments go up. That's the promise. And in recent years, inflation has been high, so yes, CPP and OAS have increased. But here's what fewer Canadians understand. Those increases don't happen in isolation. They trigger other mechanisms: tax clawbacks, income thresholds, benefit reductions. And when you layer those together, the net result for many seniors is far less generous than the headline number suggests. Policy analysts have been flagging this for months. Organizations like the Canadian Association of Retired Persons and pension researchers at major universities have been pointing to a growing gap between what's announced and what's actually delivered. The concern isn't just about dollars and cents, it's about predictability. Seniors planning their retirement need to know what they can count on, and right now, that clarity is eroding. So when you hear about a 25% jump in benefits, the first question shouldn't be, how much more will I get? It should be, what am I not being told? Let me break down what's actually happening. First, the increase itself. The 25% figure refers to a proposed or projected enhancement to certain senior benefits, specifically expanded eligibility for the guaranteed income supplement, temporary top-ups for low-income seniors, or enhanced CPP contributions for future retirees. The exact program depends on recent federal or provincial announcements, but the principle is the same. More money is being promised. That sounds good. And for some Canadians, it will be. But here's the catch, the hidden mechanism that most people miss. When your total income increases, even from government benefits, you may cross thresholds that reduce other payments you receive. This is called a clawback, and it's built into the structure of Canada's senior benefit system. Let me give you a concrete example. Old age security is subject to what's called the OAS recovery tax. If your net income exceeds a certain threshold, currently around $86,000 annually, you start losing a portion of your OAS payment. For every dollar you earn above that line, you lose 15 cents of OAS. And if your income is high enough, you lose it entirely. Now let's say you receive a 25% increase in GIS or a one-time senior benefit payment. That payment counts as income. If it pushes you over the OAS threshold, you could lose more in clawbacks than you gained from the increase. This isn't theoretical. This has already happened to thousands of Canadian seniors during pandemic-related benefit programs. Emergency payments increased their reported income, which triggered OAS clawbacks the following year. Many didn't find out until they filed their taxes, and by then, the money was gone. The second hidden factor is taxation. Increased benefits are often taxable. So that 25% boost, you're not keeping all of it. Depending on your tax bracket, you could be handing 20% to 30% back to the Canada Revenue Agency. And third, this is critical, there's the issue of eligibility tightening. Some proposed increases come with stricter income or asset tests, meaning more seniors could be excluded or forced to spend down savings to qualify. So the headline says 25% more, but the reality for many will be a bit more, taxed higher, with other benefits reduced. That's the catch. So who does this actually impact? Let's start with low-income seniors. These are Canadians who rely almost entirely on government benefits, OAS, GIS, and CPP. They're not wealthy, they don't have significant private pensions or investment income. For them, every dollar matters. If the 25% increase comes with stricter eligibility rules or higher clawback rates, they could be the ones who lose the most. Because even a small reduction in net benefits can mean choosing between groceries and medication. Next, moderate income retirees. These are people who worked full careers, paid into CPP, maybe have a small workplace pension or RRSP. Their total income might be $40,000 to $70,000 a year. Comfortable, but not lavish. For this group, the danger is crossing thresholds. A benefit increase could push them into a higher tax bracket, or trigger OAS clawbacks, or disqualify them from provincial senior programs like drug coverage or property tax credits. They think they're getting more, but the net effect could be neutral, or even negative. Then there are near-retirees Canadians in their late 50s and early 60s planning to retire in the next few years. They're trying to forecast their income, figure out when to start CPP, decide whether to draw down RRSPs early or wait. Changes like this disrupt their planning. It introduces uncertainty. And uncertainty, in retirement, is expensive. Finally, families. Adult children helping aging parents navigate the system. If your parents' benefits change unexpectedly, if they lose coverage, if they suddenly owe money to CRA, you're the one who gets the call. You're the one helping them sort it out. This affects millions of Canadians, directly or indirectly. Let's talk real numbers. Imagine you're a 68-year-old single retiree. You receive full OAS about $8,400 a year. You receive a modest CPP payment, let's say $9,000 annually. And because your income is low, you qualify for GIS another $11,000 or so. Your total income, roughly $28,400 a year. Not much, but it's predictable. You budget carefully, you manage. Now, suppose the government announces a 25% increase to GIS. That's an extra $2,650 a year. Sounds like a lifeline. But here's what happens next. That extra income pushes your total to just over $31,000. Depending on how GIS and OAS interact, and this gets technical, you could start losing some of your GIS because it's income tested against other benefits. You might lose $500 to $800 of that increase right away. Then, when you file your taxes, CRA sees your income went up. You're now in a slightly higher marginal rate. You owe an extra $400 in taxes. And because your income crossed a provincial threshold, you lose eligibility for a senior drug benefit. That costs you $600 a year in out-of-pocket medication expenses. Net result? You gain $2,650s. You lost $800 to benefit reduction, $400 to taxes, and $600 to lost drug coverage. Your actual gain? $950. That's not 25%, that's about 3.4%. Now multiply that across hundreds of thousands of Canadian seniors. The fiscal impact is enormous. The government announces a big increase, gets credit for helping seniors, but the actual outlay after clawbacks, taxes, and program interactions is far smaller. This is how policy works in practice, and it's why understanding the details matters so much. For middle-income seniors, the math can be even worse. If you're earning $50,000 a year and an increase pushes you above the OAS clawback threshold, you could actually end up with less money than before. This has happened. It's documented, and it's likely to happen again. So why is the government doing this? To be clear, I'm not suggesting bad faith. Governments face real constraints. Canada's population is aging rapidly. The number of people over 65 is growing faster than the number of working-age Canadians paying taxes. That creates fiscal pressure. At the same time, inflation has driven up costs across the board. Seniors are struggling. There's political pressure to act, so the government announces increases. But it also needs to control costs. It can't afford to simply hand out billions without limits. So it builds in mechanisms, clawbacks, income tests, tighter eligibility to target benefits, and reduce overall spending. From a policy perspective, this is called fiscal sustainability. The government is trying to balance two goals: support vulnerable seniors and keep the system affordable. The problem is that the public messaging focuses on the increase, not the limitations. And that creates confusion. Seniors hear 25% more and plan accordingly. Then they discover the fine print. There's also a broader trend at play. Over the past decade, Canada has shifted toward more means-tested benefits. Instead of universal programs that everyone receives, we're moving toward targeted programs that phase out as income rises. This is more efficient in theory. It directs money to those who need it most, but it also creates complexity, uncertainty, and disincentives. Seniors are penalized for saving. They're discouraged from working part-time. They face sudden benefit losses if their income changes even slightly. Policy experts call this the welfare wall, and it's becoming a serious problem in Canada's retirement income system. The government knows this. Internal reports from Finance Canada and the Office of the Chief Actuary have acknowledged it, but political will to fix it has been limited. So we're left with a system that's increasingly difficult to navigate, and where the gap between promise and reality keeps growing. The response from experts has been measured, but concerned. Pension researchers at institutions like the University of Toronto and Simon Fraser University have published analyses showing that benefit increases often don't translate into real purchasing power gains for seniors, especially when you account for clawbacks and taxation. Advocacy groups like CARP have called for greater transparency. They want the government to show net benefit calculations, what seniors actually receive after all adjustments, not just gross increases. Provincial governments have also raised concerns. Because many provincial senior programs are tied to federal benefit levels, changes to CPP or OAS can have downstream effects. Provinces have warned that without coordination, seniors could fall through the cracks. Economists have pointed to the long-term risks. If seniors lose trust in the predictability of their income, they'll save more aggressively, spend less, and delay retirement. That's bad for the economy. It's also bad for quality of life. And seniors themselves, those who've taken the time to understand what's happening, are frustrated. They feel misled. They feel like the rules keep changing, and they worry about what comes next. This is not a fringe concern. This is mainstream anxiety among Canada's retiree population. So what can you actually do about this? First, understand your own situation. Don't rely on headlines. Look at your actual income sources: CPP, OAS, GIS, workplace pensions, RRSP withdrawals, investment income. Add them up. Know where you stand relative to clawback thresholds. The OAS recovery tax starts at around $86,000. The GIS income test is much lower, around $20,000 for singles. If you're near those lines, even a small increase can have big consequences. Second, plan your income strategically. If you have control over when you withdraw from RRSPs or sell investments, consider timing those decisions to avoid pushing yourself over a threshold in any single year. Spread income out. Keep it predictable. Third, watch for provincial programs. Many provinces offer additional benefits for low-income seniors: property tax deferrals, prescription drug coverage, rent supplements. These are often tied to federal benefit levels. If your federal income changes, you could lose provincial support. Check eligibility carefully. Fourth, file your taxes on time every year. Even if you have no income to report, filing ensures you're automatically assessed for GIS and other benefits. Missing a tax deadline can mean losing months of payments. Fifth, stay informed. This is a moving target. Policies change, thresholds are adjusted, new programs are announced. Subscribe to updates from Service Canada. Follow reputable Canadian pension analysts. Don't assume what was true last year will be true next year. And sixth, this is important, get professional advice if your situation is complex. A qualified financial planner or accountant who specializes in retirement income can help you navigate these rules and avoid costly mistakes. This isn't something you can afford to ignore. So what happens next? That depends on several factors. If inflation remains elevated, benefit increases will continue. But so will the fiscal pressure on government. Expect more clawbacks, more means testing, more complexity. If the economy slows or if a recession hits, governments may be forced to tighten eligibility even further. We've seen this pattern before during the 1990s, during the 2008 financial crisis. When budgets get tight, seniors often bear the cost. On the other hand, there's growing political awareness of this issue. Seniors vote, and they vote in large numbers. If enough Canadians understand what's happening and demand change, policy could shift. There's also the possibility of structural reform. Some experts have proposed simplifying the system, consolidating programs, reducing clawbacks, making benefits more predictable. That would require political courage. But it's not impossible. In the short term, expect more announcements, more benefit increases, more promises, and more fine print. Your job is to read that fine print, to understand what's really changing, and to plan accordingly, because this isn't going away. The demographic and fiscal pressures driving these changes will only intensify in the years ahead. Canada's retirement income system is at a crossroads, and the decisions made now will shape the financial security of millions of Canadians for decades to come. Here's what I want you to take away from this. When you see a headline about a 25% increase in senior benefits, don't just celebrate. Ask questions. What are the eligibility rules? What are the clawbacks? How will this affect my taxes? What other benefits might I lose? Because the reality is almost always more complicated than the announcement. This isn't about being cynical, it's about being informed. It's about protecting your retirement security. It's about making sure you're not caught off guard when the details finally emerge. If you're a senior, or if you're planning for retirement, this matters. If you're helping a parent or a loved one, this matters. If you care about the future of Canada's social safety net, this matters. So stay vigilant, stay informed, and stay engaged. I'll continue to break down these issues as they develop, because this is too important to leave in the shadows. If you found this analysis valuable, please subscribe to this channel. Share this video with anyone who needs to understand what's really happening with senior benefits in Canada. And leave a comment below. Let me know your concerns, your questions, your own experiences navigating this system. We need to have this conversation, and we need to have it now. I'm Joseph. Thank you for watching, and I'll see you in the next one.